Narration, ghostwritten in Andre Geek's style. Today we're diving into the exciting world of crypto trading, specifically spot trading and high-frequency trading, or HFT. Ready to unlock some crypto profits? Let's get started. First up, spot trading. Spot trading is buying and selling cryptocurrencies at the current market price for immediate settlement. Think of it as a cash purchase. You buy the asset and boom, it's yours instantly. No waiting around, no expiration dates. Key features: ownership, you own the actual coins, immediate settlement trades are executed instantly, and no expiration. Unlike futures contracts, spot trades are always current. Let's break it down with an example. Imagine Bitcoin is trading at $30,000. You invest $1,000 and get about 0.0333 BTC. If Bitcoin's price rises to $35,000, your investment grows to $1,166.67. That's a profit of $166.67. But if Bitcoin drops to $25,000, your holdings shrink to $833.33, meaning a loss of $166.67. Now, onto strategies for maximizing those profits. First, dollar cost averaging. This means investing a fixed amount regularly, regardless of the market price. It reduces the impact of volatility. For example, invest $200 in Bitcoin every month. Over time, your average cost smoothens out, potentially leading to gains. Next, trend following. Buy during uptrends and sell during downtrends using technical indicators like moving averages. Example, if the 50-day MA crosses above the 200-day MA, it signals a bullish trend. Support and resistance levels. Identify price points where the asset consistently bounces or reverses. If Bitcoin rebounds at $28,000, buy near this level and sell near $35,000 resistance. News and sentiment analysis. Monitor market news and events. Positive news can trigger price surges. For example, a major Ethereum upgrade announcement can push prices up. Use stop-loss orders. Set an automatic sell order to minimize losses. If you buy Bitcoin at $30,000, set a stop-loss at $28,000. And don't forget arbitrage opportunities. Take advantage of price differences across exchanges. Buy BTC on exchange A for $29,800 and sell on exchange B for $30,000. Alright, let's move on to high-frequency trading, or HFT. HFT uses algorithms and trading bots to execute a large number of trades in a fraction of a second. It aims to capitalize on small price movements in highly liquid markets. Here's a quick example. Bitcoin is $30,000 on exchange A and $30,005 on exchange B. A bot buys on exchange A and sells on exchange B within milliseconds, making a $5 profit per trade. To maximize profits in HFT, use algorithmic trading. Configure bots with high-speed APIs and low-latency connections. Market-making place, buy and sell orders simultaneously to profit from bid-ask spreads. Focus on high-liquidity assets like Bitcoin or Ethereum. Leverage low fees. Choose exchanges with low trading fees to maximize net gains. Data-driven analysis. Use AI and machine learning to predict price movements. Monitor order books. Analyze for buy-sell imbalances. Latency arbitrage. Exploit time delays between exchanges. Remember, risk management is key. Use limit orders, diversify your investments, monitor the market in real time, backtest strategies, avoid overtrading, and use secure platforms. In conclusion, spot trading is ideal for beginners with its simplicity and ownership of assets, while HFT suits advanced traders with technical knowledge and resources. Both methods, combined with the right strategies and risk management, can generate substantial profits in the volatile crypto market. So, that's a wrap. Ready to dive into the world of crypto trading? Smash that like button if you found this video helpful, and subscribe for more crypto insights. Happy trading!